The global financial landscape is currently rife with anxiety, driven by concerns that the Federal Reserve may have kept its interest rates too high for an extended period. This apprehension is rooted in fears of an impending U.S. recession, despite recurring recession signals proving inaccurate post-pandemic. Remarkably, the economy has showcased steady growth and a resilient job market, defying analysts' predictions of downturns. Traditional recession indicators like rising unemployment rates and the inverted yield curve have faltered in their predictive power, adding to the confusion and uncertainty. In this unique post-pandemic era, the usual economic rules seem to no longer apply. With the Fed's cautious stance on interest rates and the continuous emergence of false recession alarms, one might wonder, can we still rely on traditional economic indicators to forecast future downturns? Or is it time to redefine our understanding of economic resilience? The Fed's high rates spur fear of slowdown, yet recession signals have so far proved wrong. The turbulence in global financial markets highlights a sudden anxiety that the Federal Reserve might have kept its key interest rate elevated for too long, raising the likelihood of a U.S. recession. This concern has led economists and Wall Street traders to anticipate faster cuts to the Fed's benchmark rate than previously thought. This rate influences borrowing costs for both consumers and businesses, and Fed Chair Jerome Powell has often emphasized the Fed's ability to quickly lower rates to support the economy if needed. Despite recurrent fears of a recession, the post-pandemic economy has consistently defied such predictions. Instead of succumbing to downturns, it has demonstrated steady economic growth and robust hiring. Historically, the U.S. economy signaled impending recessions through certain indicators, but these signals have become unreliable since the COVID-19 pandemic disrupted typical business activities. One such indicator is the unemployment rate, which saw an uptick from 4.1% to 4.3% in July, according to the Labor Department's report. Although this rate is still relatively low, it marks the highest in nearly 3 years, causing markets to panic due to its association with the SAM rule. Named after former Fed economist Claudia Sahm, this rule suggests a recession is underway when the 3-month average unemployment rate rises by half a percentage point from its low in the previous year. The logic is that increasing unemployment leads to reduced consumer spending, which in turn harms businesses and prompts further job cuts. However, Claudia Sahm herself doubts the imminence of a recession. The current rise in unemployment isn't due to companies cutting jobs, but rather an influx of people entering the job market, many of whom haven't secured employment yet. Jay Bryson, chief economist at Wells Fargo, acknowledges the increased risk of recession due to the rising unemployment rate, but remains optimistic about the economy's ability to endure without major shocks like spikes in oil prices or housing busts. Other traditional recession indicators have also lost their predictive power in the post-pandemic era. The inverted yield curve, where short-term bond yields exceed long-term ones, typically signals a forthcoming recession. However, despite such inversions occurring since July 2022, a recession has not materialized. The Fed's significant rate hikes since March 2022 were expected to cool the economy and control inflation, but the anticipated recession never occurred. One explanation for this anomaly is the massive financial assistance provided by the government during the pandemic, amounting to around $5 trillion in 2020 and 2021. This support allowed consumers and businesses to maintain spending and investment without relying heavily on borrowing, thus mitigating the impact of the Fed's rate hikes and diminishing the signal from the inverted yield curve. Similarly, the rule of thumb that 2 consecutive quarters of declining GDP signifies a recession was challenged in 2022. Although the top-line economic numbers indicated shrinking output, underlying measures excluding volatile items like inventories and government spending showed continued economic expansion. Jerome Powell has acknowledged the unusual nature of the current economic situation, noting that many traditional rules have not applied. During a news conference, he mentioned that while aware of the SAM rule, other recession signals, such as changes in bond yields, have not been consistent in recent years. Looking ahead, financial markets and economists predict that the Fed will cut rates more swiftly to counteract economic weaknesses. Bryson expects significant rate cuts in September, November, and December, marking a departure from Wells Fargo's previous, more gradual forecast. Some analysts even speculate about potential emergency rate cuts before September, although this seems unlikely without further signs of economic distress. The post-pandemic economy continues to puzzle economists, defying long-standing recession indicators and showcasing resilience. This period has been marked by unique economic dynamics, challenging traditional wisdom and raising questions about our ability to forecast future downturns accurately. As we navigate these uncertain times, it's crucial to reconsider our reliance on traditional economic indicators and explore new frameworks to understand economic resilience. With the evolving economic landscape, can we trust these age-old signals, or is it time to redefine our approach to predicting economic futures? Share your thoughts and insights on how we should adapt to these changes.